Well, the federal budget 2016 adds over $100 billion over 5 years. But from an economic standpoint, what does it mean for Canada's economy, interest rates, and the Loonie? Beata Caranci, Chief Economist, TD Bank Group. Well, Beata, what does it do? Does it do anything to your quarterly forecast?
Not on the near term, especially with lags in terms of when a budget is announced to when money actually flows out to the provinces, to the individuals, and to the municipalities. So it's more of a 2017 impact. It added about 0.3 of a point to our forecast. So we're forecasting 2% for 2017. Okay. Had it not been that, it would have been a sub 2% number. But for this year, it's very minimal.
All right, and you know, it doesn't seem like a lot for $100 billion. I don't know if anybody can fathom that much, but I guess it does move the needle a little bit.
It does, and we're operating within a $2 trillion economy, so it is significant and it will stimulate the economy. But because there were significant expenditures happening on the infrastructure side in particular, that does have lag times in terms of when it actually turns into a shovel and create jobs. So, and this is why, from the near-term perspective, it has a very modest impact. It's more the impacts in 2017 and beyond where it'll be more material.
All right, so for this quarter, you said we have some good news?
So this quarter, this is the first time overall when we've done a quarterly economic forecast in about a year that we've upgraded our Canadian forecast. And we did it before we saw the budget number, so it wasn't related to the expenditures that were coming out of there. The first quarter GDP number is looking like it could be as high as 3% for Canada. Nice. A lot of that is a trade story, very good rotation of growth towards exports. It's what we've been waiting for. It's what we didn't get last year that everybody was anticipating. And it was coming through with many more lags than we were looking at. But it does look like it's solidified in the first quarter, and we could get double-digit growth out of exports, which is great. And the consumers held in pretty well in the first quarter as well. I don't think that 3% is going to hold as we go forward. Part of that is catch-up from the weakness we had last year, so you get a lot of volatility in this data. So we will probably go more towards this 1.5–2% growth going forward, but it's a great start to the year.
All right. And does it change anything for our interest rates at all?
Not at this time. Keeping in mind, we had extremely weak growth last year. Right. We're projecting about 2% for this year and next year. So it's a very even keel pace of growth. And what's very important within the numbers, we often think of, what did GDP do? And then you say 2%, great. But there's a lot of components in there. And where is that growth coming from? In terms of domestic demand, meaning business investment and consumer spending, that likely will track about 1% this year. So the gap between the headline number and these domestic demand components is going to be the widest we've seen since 1999. So if I'm the Bank of Canada and I'm looking at a structural change in the economy more towards the export sector, and I'm looking at a generally weak domestic demand profile, I would say, it's probably safe to sit on the sidelines and allow for the structural rotation to take hold, gain some deeper roots, and then move forward after that. So we're not looking for a Bank of Canada rate hike probably out until 2018.
So still quite a wait and see.
Long time, yeah.
Interesting.
Yeah.
All right, Canadian dollar, the Loonie, anything, we're a little better right now, but what do you see for that?
So very similar story. Because our Canadian outlook is highly dependent on what's happening in terms of the export sector, the upside to the Canadian dollar is somewhat limited. If it were to rise too quickly and get to too elevated levels, you would start to see your demand side on exports fall, and that would compromise your economic growth, and that would pull down your currency again. So you get into these cycles. So ultimately, we feel that the Canadian dollar is likely going to be range bound, somewhere between 72–73 cents on the low end and 76–77 cents on the upper end, somewhere in that range over the course of the next couple of years. There's a lot of volatility to the currency. The one risk is it's been highly tied to movements in oil lately. Right. And so we saw this nice rebound in oil happen, and it's stabilized for the time being. But there is always that risk that the dollar gets batted around with the direction of oil. And what we've seen since about 2014 is the correlation of the Canadian dollar to oil has really tightened up. So where oil goes, it can certainly move around our dollar a lot.
And speaking of oil, one thing I noticed in the federal budget, there wasn't a lot for, really a lot for Alberta and all the trouble they've been having. What do you think of that?
A little tough for the federal government to do policy tailored to provinces, because that's what your provincial governments are for, and then your municipal governments after that. So they do have to have a very broad-based national plan, and they did do some refinement on the employment insurance in terms of enhanced benefits and extended access. So Some of that will certainly benefit those provinces that are struggling, but in terms of a targeted fiscal measure to a particular province, you're correct. There's nothing specific on that front. Yeah.
Now, $100 billion seems like a lot to me for a deficit, but what does it do to our long-term debt and our debt to GDP ratios?
Yeah, debt to GDP ratio is a common way people look at it. It's their ability to pay off of the size of your economy. So from that perspective, the ratio is rising. It's rising very slowly, incrementally. But ultimately, when you look at our debt to GDP ratio relative to our peers, which is generally the G7 countries that we compare ourselves to, it's very low, it's stable. And so from that perspective, we're definitely in good stead. And also, what we noticed out of the government is they use pretty conservative assumptions on nominal GDP. So it's possible that those ratios could end up being better than we expect if the economy does better going forward.
All right, so far so good anyway. All right, thank you very much, Beata.
My pleasure.
I've been joined by Beata Caranci, Chief Economist, TD Bank Group. I'm MaryAnn. Thanks for watching.